Amidst the roller coaster ride of uncertainty, the world's markets have found a glimmer of hope, celebrating the possibility of a soft landing for the U.S. economy. This unexpected turn of events has left investors and economists alike astonished and bewildered. Last week's surge in stock and bond prices was ignited by the release of positive consumer and producer price inflation reports, hinting that the U.S. might conquer inflation without falling into the clutches of a recession. Who could have foreseen this resilience? The U.S. economy has defied expectations and exhibited a tenacity that challenges conventional wisdom. But beneath the surface, a fascinating revelation emerges, one that points to a potential secret weapon against the impending storm. As we delve into this enigma, we wonder, can the U.S. economy truly weather the storm? Or are there still challenges ahead that could derail this astonishing recovery? Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. In a world of economic unpredictability, the recent trajectory of the U.S. economy has left experts stunned and intrigued. With stock markets soaring and bonds rallying, there's a newfound optimism surrounding the possibility of a soft landing for the U.S. economy. The catalysts for this surprising turn of events were the better-than-expected consumer and producer price inflation reports, raising hopes that inflation can be tamed without plunging into a recession. One aspect that caught many by surprise was the unyielding resilience displayed by the U.S. economy. The predicted peak inflation, long anticipated, was overshadowed by the steady decline in oil, food, and commodity prices that followed last year's war-related spikes. As a result, inflation eased, and year-on-year measures showed moderation compared to the elevated prices of the past. The abating pandemic-induced shortages of computer chips and other goods paved the way for increased production and lower prices. Additionally, the rental market, which experienced a slowdown in the first half of the year, seemed to contribute to a decline in shelter inflation, a significant component of U.S. consumer price indices. U.S. headline consumer price inflation is projected to dip below 3%, and core measures of inflation may even approach the Federal Reserve's 2% target within the next year. This prospect of a soft landing for the economy has left many economists in awe. The prevailing belief was that taming inflation would come at the cost of a recession, given the perceived insurmountable headwinds posed by aggressive Fed rate hikes, declining pandemic-related fiscal spending, and sluggish growth in major economies like Europe, Japan, and China. The bond market's deeply inverted yield curve, a reliable harbinger of recessions, added to the anxiety. However, the latest economic data paints a different picture. The labor market continues to generate new jobs, and consumer spending, particularly on services, remains resilient. Even sectors that once exhibited weakness, such as residential housing, have shown renewed strength. Of course, challenges persist, especially in commercial real estate due to higher borrowing costs and remote work trends, alongside weaker business investment spending and a drag on U.S. economic activity from net exports. Yet, amidst this resilience lies a less explored factor that may be contributing to the economy's ability to withstand the current challenges. A shift in household and corporate borrowing behavior since the global financial crisis of 2008 may be making U.S. private sector spending less sensitive to interest rates than previously thought. Over the past 15 years, U.S. households and creditors have adopted a more prudent approach to borrowing and lending. The stock of U.S. household debt relative to GDP has decreased significantly despite a prolonged period of low interest rates. Banks and mortgage lenders have tightened credit standards, and borrowers have gravitated towards longer-term fixed-rate housing finance. These changes have made housing debt less susceptible to interest rate fluctuations. Similarly, the corporate sector has displayed modest borrowing dynamics. Corporate debt as a share of corporate net worth is at 50-year lows, indicating restrained borrowing despite the availability of abundant credit opportunities during the super low interest rate era. While indebtedness has significantly increased in the public sector, the U.S. federal government is not facing immediate cash constraints. The evidence suggests that private sector demand for U.S. debt securities remains strong, even amid rising government indebtedness and debt servicing costs. Divided government in a politically polarized environment also points towards a continuation of the status quo, making sharp fiscal consolidation unlikely in the near future. So, what does this newfound resilience mean for the U.S. economy? Is it destined for a soft landing, or are there hidden vulnerabilities yet to be uncovered? As we explore the intricacies of this economic puzzle, we invite you to share your perspective on the factors shaping the U.S. economy's journey ahead. Can this resilience withstand the unpredictable forces of the world? Share your thoughts in the comments section below, and remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.